Alright guys, so you want to get into trading, or maybe you're already trading but not seeing the results you want. Let me tell you, trading success isn't some mystical secret or just pure luck. It really boils down to following a set of proven rules consistently. Think of it like trying to build a multi-million-dollar real estate portfolio. You wouldn't just start buying properties randomly without a plan, right? You need a blueprint, a strategy. Without these foundational rules in trading, you're essentially just gambling with your hard-earned cash, and trust me, that's a fast track to an empty bank account. Now, these rules I'm about to share with you aren't just some random ideas I cooked up. Oh no, these are principles that are deeply rooted in common sense, backed by reputable sources, insights from legendary traders who've made fortunes, and countless real-world examples of what separates the consistently profitable traders from the ones who blow up their accounts. We're talking about timeless strategies that have been proven to work, not just in bull markets, but in all market conditions. These are the building blocks for long-term success. So, in this video, we're going to break down exactly what you need to know. We're diving deep into crafting a solid trading strategy, mastering risk management so you can protect your capital, which is priority number one. Developing the ironclad discipline required to stick to your plan even when your emotions are running wild, and sharpening your market awareness to spot those golden opportunities and sidestep those dangerous pitfalls. Get ready, because this is the stuff that can actually make a difference in your trading journey. Alright guys, first things first, and this is absolutely non-negotiable, like seriously, if you take away only one thing, this might be it. You absolutely need a trading plan. This isn't just a suggestion, it's the bedrock of any successful trading career. Think of this as your personal business plan for the markets. It's not some vague idea floating around in your head. It needs to be a concrete, written down document that meticulously outlines exactly how you're going to approach every single trade. This plan must detail your entry signals. What specific criteria, what chart patterns, what indicator readings need to align perfectly before you even consider clicking that buy or sell button. It also needs to clearly define your exit points. Under what conditions will you take your profits? And just as crucially, when will you admit you're wrong and cut your losses to live to trade another day? And of course, it has to specify your overall objectives and precisely how much of your precious capital you're willing to risk on any single trade. Without this comprehensive blueprint, you're not trading. You're just gambling. And trust me, the market is a very expensive casino if you don't have a defined edge. So let's make this practical. Imagine you're analyzing a stock. Let's call it Awesome Tech Inc. Your trading plan might explicitly state something like, I will initiate a long position in Awesome Tech Inc. if and only if the price closes decisively above its 50-day simple moving average on the daily chart, and simultaneously the relative strength index is above 50 but not yet overbought, for example, below 70, indicating upward momentum with room to run. Then, for your risk management component, which is key, I will place a hard stop-loss order exactly 2% below my entry price, or just below the most recent swing low, whichever is wider, to protect my capital. My initial profit target will be set at a risk-to-reward ratio of at least 1 to 2, meaning if I'm risking $100, I'm aiming for a $200 profit. See how specific that is? It's measurable, it's repeatable, and it removes the emotional roller coaster from your decision-making process. This plan is your boss. You follow it religiously. No ifs, ands, or buts, especially when your emotions are trying to convince you otherwise. It's the absolute foundation upon which consistent, profitable trading is built. So don't even think about skipping this step. Okay, rule number 2, and this one is a classic. For a very good reason, it can save you a tremendous amount of frustration, and more importantly, a significant amount of your trading capital always, and I really mean always, endeavor to trade in the direction of the prevailing market trend. You've undoubtedly heard the old adage, the trend is your friend, right? Well, it's become a cliche because it's profoundly true and incredibly important for increasing your odds of success. Trying to consistently fight a strong, established market trend is like trying to swim directly against a powerful ocean current, or trying to drive the wrong way down a one-way street. You might make a tiny bit of progress here and there. You might get lucky once or twice, but inevitably, you're going to expend a massive amount of energy, take on unnecessary risk, and ultimately, you're far more likely to get overwhelmed and swept away by the dominant market force. Identifying whether the market, or the specific instrument you're trading is in a clear uptrend, a downtrend, or simply chopping around in a sideways consolidation phase is a fundamental skill that you absolutely need to develop early on. So, how do you actually put this into practice? It's simpler than you might think. If a stock or an index is in a clear uptrend, which is typically characterized by a series of higher highs and higher lows on your chosen time frame, then your highest probability trades will be looking for opportunities to buy or go long. For instance, in a confirmed uptrend, you might patiently wait for the price to experience a temporary pullback to a key area of support. This could be a well-respected moving average like the 20-day or 50-day, a previous resistance level that has now flipped to become support, or a Fibonacci retracement level. Once the price reaches such an area and shows signs that the uptrend is ready to resume, like a bullish candlestick pattern or a bounce with increasing volume, that's your cue to consider an entry. Conversely, in a clear downtrend, with lower lows and lower highs, your focus should be on finding opportunities to sell short on corrective rallies up to resistance. Actively fighting the dominant trend is a low-probability, high-stress game, and as smart traders, we're all about stacking the odds firmly in our favor, not making things harder for ourselves. Alright, next up, and this is a habit that, for some reason, so many traders, especially those who are struggling, tend to skip much to their financial detriment. You absolutely must keep a detailed trading journal. Seriously guys, this is not just busy work. It's like having your own personal trading coach, your performance analyst, and your psychological profiler all rolled into one incredibly powerful tool. Every single trade you execute, the wins, the losses, especially the losses, and even the trades you seriously considered taking but ultimately decided against, should be meticulously recorded. Why go to all this trouble? Because your memory, especially when it comes to money and emotions, is notoriously unreliable and often biased. You'll remember the big wins vividly, but conveniently forget the string of small, frustrating losses. A trading journal provides an objective, unvarnished record of your decisions, your thought process at the time you made the trade, the market conditions, and the precise outcomes. It's the raw, hard data you desperately need to identify what strategies are working for you, what mistakes you keep repeating, and where your personal trading edge truly lies. So what exactly should you be tracking in this journal? Well, the more detailed the better, but at a bare minimum you need the date and time of entry and exit, the specific asset or instrument traded, for example AAPL stock or EUR-USD currency pair, your exact entry price, your exact exit price, the reason or setup for taking the trade. What was your edge, the position size, your predefined stop-loss level, your initial profit target, the commission paid, and of course, the net profit or loss for that trade. But here's a pro tip: also include notes on your emotional state before, during, and after the trade. Were you feeling confident, fearful, greedy, impatient? Over time, as you accumulate this data and regularly review it, say weekly or monthly, you'll start to see undeniable patterns emerge. Maybe you'll discover you're fantastic at picking entries for trend-following trades, but consistently exit your winners too early. Or perhaps you'll notice that you tend to break your rules and over-leverage when trading highly volatile meme stocks. A simple spreadsheet or a dedicated journaling software will do the trick. This regular, honest review of your journal will become one of the most valuable activities you undertake to systematically refine your strategy, improve your discipline, and ultimately boost your profitability. This next rule, guys, is arguably the absolute cornerstone of sustainable trading, perhaps the most critical one on this entire list. And it's something I hammer home constantly. You absolutely, positively practice strict, unwavering risk management. I really cannot overemphasize this point enough. You could possess the most brilliant, high-probability trading strategy ever devised, one that predicts market turns with uncanny accuracy. But if you fail to manage your risk properly on each and every trade, you will, without a shadow of a doubt, eventually blow up your trading account. It's not a question of it will happen, but the primary goal in trading, especially when you're starting out, isn't just to make a ton of money quickly. It's to long enough to allow your edge to play out and make money consistently over time. And that means you need to protect your trading capital as if it's your most precious asset, because frankly, in the world of trading, it absolutely is your lifeline. Without capital, you can't trade, period. A very common and highly effective guideline for individual trade risk, and one that I personally advocate for, especially for newer traders, is the 1% or 2% rule. This principle is simple, yet incredibly powerful. It dictates that you should never risk more than 1% or at the absolute maximum, 2% of your total available trading capital on any single individual trade. So, let's break that down with an example. If you have a $10,000 trading account, applying the 1% rule means you should not risk more than $100 on one trade. If you opt for the 2% rule, your maximum risk per trade would be $200. This risk is calculated based on the difference between your entry price and your stop-loss price multiplied by your position size. If your planned trade setup, based on where your stop-loss needs to be placed for the trade to make sense, would result in a potential $500 loss on that $10,000 account, that's a 5% risk, which is generally considered far too high for a single trade, as a few consecutive losses could severely cripple your account. This rule forces you to be highly selective with your trades and, crucially, ensures that even a string of unavoidable losing trades, and they will happen to every trader, won't wipe you out of the game. It helps keep you emotionally balanced because no single trade has the power to financially devastate your account or your mental state. Alright, building directly on our crucial discussion about risk management is our next indispensable rule. Always, and I cannot stress this enough, use stop-loss orders for every single trade you take with very few exceptions. Think of a stop-loss order as your predefined, automatic exit strategy if a trade moves decisively against your anticipated direction. It's essentially an instruction you place with your broker to automatically sell a security if you're long, or buy it back if you're short when it reaches a specific predetermined price level, thereby capping your potential loss. So many traders, especially those new to the game, shy away from using stop losses. They might be afraid of getting stopped out prematurely by normal market volatility, only to watch in frustration as the price then reverses and moves in their originally intended direction. But trust me on this one, the relatively small pain and annoyance of a planned limited loss is absolutely nothing compared to the gut-wrenching agony and severe financial damage of a massive, uncontrolled loss. Here's a straightforward, practical example to illustrate the power of a stop loss. Let's say you decide to buy shares of XYZ Innovations at $50 per share because you believe it's poised for a significant move upwards. Now, before you even click that buy button, your trading plan should dictate where you'll exit. Perhaps your analysis indicates that if the stock price drops below $45, your thesis is invalidated. So, when you place your buy order, you simultaneously place a stop-loss sell order at $44.95. If the stock price falls and hits $44.95, your stop-loss order automatically triggers, and your shares are sold, limiting your loss to approximately $5.05 per share. Without that stop loss in place, if XYZ Innovations plummets to $30, you'd be staring at a crippling $20 per share loss. Stop losses are critical because they take the emotion and guesswork out of exiting a losing trade. The decision is made rationally and objectively. Your money is on the line. This rule flows directly from using stop losses, but it emphasizes the critical and required you have to become ruthless and disciplined about cutting your losses quickly and without hesitation. It's undeniably one of the most challenging psychological hurdles for traders to overcome because, let's be honest, nobody enjoys admitting they were wrong, especially when money is involved. Our innate human ego often gets in the way. When a trade starts moving against us, it's so tempting to think, oh, it'll come back, or I'll just give it a little more room. It's bound to bounce from here. Or even worse, I'll add to my losing position because now it's cheaper. This kind of hope-based trading, where you're praying for a turnaround rather than adhering to your predefined plan, is a surefire recipe for disaster. It's how small, manageable losses get an opportunity to morph into account-crippling catastrophes. Remember, your primary job as a trader isn't to be right on every single trade because that's impossible. It's to effectively manage your risk and protect your capital so you can trade another day. So, the moment a trade hits your predetermined stop-loss level, that's your cue to exit. Period. No second guessing, no emotional overrides, no, let me just wait and see for a few more minutes. Your stop-loss is there for a reason. It represents the point at which your original trade idea is invalidated. Honor it. Furthermore, there might be situations where the fundamental reason you entered the trade changes, your stop-loss is hit. For example, if you bought a biotech stock expecting positive clinical trial results and the company announces the trial failed, even if your stop loss hasn't been triggered yet, the entire premise for your trade has evaporated. In such cases, you should strongly consider exiting the trade immediately. Selling at a small controlled loss not only preserves your precious trading capital, but just as importantly, it frees up your mental capital and emotional energy to move on and focus on finding the next high-probability opportunity. Stubbornly holding on to losers ties up both your money and your mind, preventing you from capitalizing on better setups. Now let's talk about the other side of the coin from cutting losses quickly. And this, my friends, is where the real magic happens, and where significant profits are actually made in trading. You absolutely must learn how to let your profits run. This sounds deceptively easy, doesn't it? Just hold on to your winners. But in practice, it's surprisingly difficult for a vast majority of traders, especially those who are newer to the game. What typically happens is we get a little bit of profit on a trade, say 5% or 10%, and immediately that fear of giving those unrealized gains back to the market kicks in. This fear of round-tripping the profit often causes us to snatch our winnings off the table far too quickly, leaving substantial potential gains unrealized. If you're consistently taking very small wins, but you also have small losses, even if you're disciplined about cutting them quickly as per rule number 6, your overall profitability is going to struggle to grow significantly. It's the outsized wins, the trades that run much further than you initially expected, that truly pay for all the small unavoidable losses and give your trading system that crucial positive expectancy needed for long-term success. So, how do you actually accomplish this feat of letting winners run without becoming paralyzed by the fear of a reversal that wipes out all your hard-earned gains? One very popular and effective technique is to use a trailing stop loss. As the price of the asset moves favorably in your direction, you systematically adjust your stop loss order upwards for a long trade or downwards for a short trade, thereby locking in a portion of your accumulated profits while still giving the trade room to continue its favorable move. For example, let's say you bought a stock at $50 and your initial stop loss was at $45, risking $5 per share. If the stock rallies to $60, you might then trail your stop loss up to $55. At this point, you've effectively locked in a minimum profit of $5 per share, even if the stock reverses and hits your new stop. If it continues to climb to 70, you could then trail your stop to 65 and so on. The key is to have a clear, predefined plan for managing profitable trades and taking profits just as you have a plan for cutting losses. Don't just exit a winning trade because you're feeling good about a small gain or because you're scared. Let your strategy and your trailing stop dictate your exit. Alright, let's dive into a more specific, yet flexible risk management framework that some traders find very helpful. It's often referred to as the 3-5-7 rule, though the exact percentages can vary depending on the trader's style and risk tolerance. This isn't a rigid, unbreakable law, but it provides a really solid set of guidelines for managing your overall portfolio risk and individual trade risk, helping you stay disciplined and protect your capital. The 3 in this rule typically stands for risking no more than say 2% to 3% of your total trading capital on any single individual trade. This is a bit more liberal than the ultra-conservative 1% rule we discussed earlier, so it might be more suitable for traders who have gained some experience, have a well-tested strategy, or perhaps have a slightly higher tolerance for risk. However, the fundamental principle remains exactly the same. Strictly limit your potential downside on every position you take. You must carefully determine what percentage feels right for your personal comfort level, your account size, and your trading strategy's historical performance. The 5 in the 3-5-7 rule often refers to limiting your total correlated risk exposure across all your open positions to no more than, say, 5% to perhaps 10%, or even up to 15 or 20% for very aggressive, experienced traders, but that's really pushing it, of your total trading capital at any single point in time. This is crucial because if you have multiple positions open that are highly correlated, for example, several tech stocks that tend to move together, an adverse market move could hit all of them simultaneously. So, if you have a $10,000 account and you're using a 5% total exposure limit, you wouldn't want the sum total of all your potential losses to exceed $500. The 7 can have a couple of interpretations. Some traders use it to represent a maximum drawdown limit, meaning they might take a break or reevaluate their strategy if their account value drops by 7% from its peak. Others might use it in the context of a profit target, aiming for a 7% gain on a trade, or more commonly, ensuring their average winning trade is significantly larger than your average losing trade, often aiming for a win/loss ratio where winners are at least 1.5 to 2 times the size of losers. For example, if risking 2% to make 4 to 7%. The core idea behind these numbers is to enforce a structured approach to risk that protects your capital from catastrophic losses and guides your trade selection and position sizing decisions. This next rule, guys, is all about what goes on between your ears, your mindset. And it is an absolute game changer, often the deciding factor between long-term success and failure in trading. You must cultivate and maintain unwavering discipline. You can have the most sophisticated trading plan ever created, the most robust risk management rules meticulously defined. But if you lack the discipline to follow your own rules consistently, day in and day out, then all that planning is utterly worthless. Discipline is the vital bridge that connects your well-thought-out trading strategy to your actual real-world trading results. It means having the mental fortitude to stick to your predefined rules even when it feels incredibly uncomfortable, even when your raw emotions like fear, greed, hope, or regret are screaming at you to do something entirely different, something impulsive, like chasing a stock that's already run up massively, or desperately holding onto a losing trade far beyond your stop loss, hoping it'll magically turn around, or even doubling down on a loser. True discipline is about executing your plan flawlessly, almost robotically, regardless of the market's gyrations or your internal emotional state. Let's consider a tale of two traders. Trader A has a reasonably good but not perfect trading plan and follows it with ironclad, unwavering discipline. Trader B, on the other hand, possesses a truly brilliant, potentially highly profitable plan but constantly deviates from it. Trader B might get scared out of good trades too early, get greedy and overstay winning trades until they turn into losers, or engage in revenge trading after a loss, trying to make it back quickly by taking unplanned, high-risk trades. Who do you honestly believe will be more consistently successful and profitable in the long run? It's Trader A without a shadow of a doubt every single time. Discipline in trading means not overtrading when your setups aren't there, not engaging in revenge trading, not impulsively increasing your position size beyond your risk parameters after a string of wins. Euphoria is dangerous. And not deviating from your entry and exit criteria. It means doing the often boring, sometimes frustrating, but absolutely essential repetitive work of following your system. This is frequently the hardest part of trading, far more challenging than just finding a profitable strategy, but it is, unequivocally, the cornerstone of sustainable, long-term success in the markets. Alright guys, the financial markets are not static. They are a dynamic, complex, and constantly evolving ecosystem. Strategies that worked incredibly well 5 years ago might be less effective today, and new opportunities and challenges are always emerging. Therefore, if you want to not only achieve success, but also sustain it in the long run, you absolutely need to embrace the principle of continuous learning. Rule number 10 is simple but profound. Your trading education never, ever stops. The very moment you allow yourself to think, "I've got this figured out, I know it all now," is precisely the moment you're inadvertently setting yourself up for a very humbling and potentially very expensive lesson delivered by the market itself. There are always new trading strategies and methodologies to explore, new market dynamics and inter-market relationships to understand. Think about how AI is changing things, or shifts in global economic policies. New analytical tools and software indicators to learn about, and perhaps most importantly, there are always new layers to uncover about your own trading psychology, your biases, and your emotional triggers. You must strive to be a perpetual student of the markets. So, how do you actively engage in this continuous learning process? Well, there's a wealth of resources available. Make it a habit to read books written by successful, experienced traders and investors, not the get-rich-quick types, but those who share genuine wisdom and timeless principles. Follow reputable financial news sources and analysts, but always do so with a critical and discerning eye, as we'll discuss in a later rule about forecasts. Watch high-quality educational videos like this one, shameless plug, and consider enrolling in well-structured courses or workshops if you want to deep dive into specific areas. And here's a massively important tip, especially if you're just starting out or if you're experimenting with a new strategy or market, make extensive use of demo accounts. A demo account allows you to trade with virtual money in real-time market conditions. It's the perfect, risk-free sandbox environment to practice your skills, rigorously test your trading rules, build confidence, and make all your beginner mistakes without losing a single cent of your real hard-earned cash. The learning curve in trading can indeed be steep and challenging, but a steadfast commitment to lifelong learning will significantly flatten that curve and accelerate your journey towards proficiency. Okay, let's broaden our perspective on capital protection with rule number 11, a concept that's fundamental to investing, but also highly relevant to active trading. Diversify your investments and your trading activities where appropriate. You've all heard the age-old wisdom, don't put all your eggs in one basket, and it's a timeless piece of advice for a very good reason. While the degree of diversification might differ between a long-term investor and a very short-term day trader, the underlying principle of not concentrating all your financial risk into one single stock, one specific sector, or one solitary type of asset remains critically important across most financial endeavors. If your entire trading capital is tied up in, say, just one volatile tech stock, or all in cryptocurrency, or solely in companies within the airline industry, and then that specific asset takes an unexpected severe nosedive, your entire trading account could suffer a massive, potentially devastating blow. Diversification is a key strategy to help spread out and mitigate that kind of concentrated risk. For active traders, diversification can take several forms. It could mean trading a variety of different, ideally uncorrelated assets. For example, instead of just trading US tech stocks, you might also trade currency pairs in the forex market, or perhaps commodities like gold or oil, or even index futures. Within the stock market itself, diversification could involve trading stocks from different economic sectors, perhaps some technology, some healthcare, some consumer staples, some energy, because these sectors often don't move in perfect lockstep with each other. For instance, a portfolio allocation for a swing trader might involve having positions in 5 to 10 different stocks across 3 to 4 different sectors, ensuring no single position represents too large a portion of their overall risk. The core idea is that if one particular asset class is underperforming, another less correlated one might be performing well or holding steady, thereby smoothing out your overall equity curve and reducing volatility. However, a word of caution. Be careful not to over-diversify into too many instruments you don't truly understand, as that can dilute your focus and lead to mediocre results. It's about finding a smart balance. Now, this next rule might initially sound like it directly contradicts our earlier rule about always trading with the trend, rule number 2, but it's a more nuanced concept that's about recognizing specific opportune moments. Rule number 12 is to be willing to adopt a contrarian stance when it genuinely, strategically pays to do so. This absolutely does not mean you should blindly bet against every popular opinion or fade every strong trend just for the sake of being different. That's a surefire recipe for consistently losing money and fighting an uphill battle. Being an effective contrarian means skillfully identifying situations where the prevailing market sentiment has reached an unsustainable extreme. Either extreme, irrational pessimism where everyone is panicking and selling, or extreme, unbridled euphoria where everyone is blindly buying with no regard for valuation. It's in these moments of mass psychological imbalance, where the herd is overwhelmingly leaning one way, that the underlying fundamental value or technical indicators might strongly suggest an impending reversal is highly probable. These are the situations where some of the most significant and rewarding trading opportunities can be found, but capitalizing on them requires immense courage, conviction, and exceptionally solid analysis. Think about a major stock market crash, like the one in March 2020, or the depths of the 2008 financial crisis. When fear is rampant, when headlines are screaming doom and gloom, and when virtually everyone is panicking and selling indiscriminately, that's extreme pessimism for you. That can often be a prime buying opportunity for a well-prepared, disciplined contrarian investor or trader. This is the trader who has done their homework, identifies fundamentally sound companies whose stock prices have been unfairly pummeled due to the widespread panic rather than any deterioration in their actual business, and sees incredible long-term value. Baron Rothschild is famously quoted as saying, "The time to buy is when there's blood in the streets, even if the blood is your own." However, let me offer a very significant word of caution here. Being a successful contrarian is exceptionally difficult and inherently risky. You need to have incredibly strong, well-researched reasons and robust analytical evidence to support your contrarian stance, because you are, by definition, betting against the prevailing momentum and the collective sentiment of the crowd. And as the saying goes, the market can stay irrational much longer than you can stay solvent if you're not careful with your risk management and position sizing when taking such trades. This rule is absolutely paramount and is something that many novice traders tend to neglect because they get hyper-focused on finding that perfect entry point. Rule number 13 is this. You know your exit strategy, you even consider getting into it. This means having clearly defined profit targets where you'll take your winnings and non-negotiable stop-loss levels where you'll cut your losses if the trade goes against you. Embarking on a trade without a pre-planned exit strategy is akin to setting off on a cross-country road trip without knowing your final destination, without checking your fuel gauge, or without knowing when you'll need to stop. You'd just be driving aimlessly and recklessly, and in the financial markets, that approach is incredibly dangerous and almost guarantees you'll eventually crash and burn. So, before you hover your mouse over that buy or sell button, you need to ask yourself several critical questions. If this trade works out as I anticipate, at what specific price level will I take my profits? Will I take all my profits at one level, or will I scale out at multiple targets? If this trade turns against me, at what exact price level will I accept the loss and exit to protect my capital? Is there a time-based component to my exit plan? If this trade doesn't show positive movement within a certain number of days or weeks, will I consider exiting even if targets aren't hit? Having these parameters established removes emotional turmoil and impulsive decision-making that creeps in when your real money is on the line. It allows you to manage trades objectively, based on your predefined plan, rather than succumbing to fear, greed, or hope that can cloud your judgment once a trade is live. Alright, rule number 14 delves into developing a crucial skill, the ability to recognize recurring market patterns and understand the broader market cycles. Financial markets rarely move in perfectly straight, predictable lines. Instead, they ebb and flow, moving in discernible waves and often adhering to recognizable cyclical patterns of boom and bust, periods of accumulation, where smart money is quietly buying, followed by periods of distribution, where they're selling to the less informed, and the ever-present oscillations between widespread fear and unbridled greed. Gaining a solid understanding of these overarching patterns and market phases can provide you with a significant analytical edge by offering crucial context for your individual trading decisions. This isn't about possessing some mystical crystal ball, rather, it's about understanding probabilities and typical market behavior based on historical precedent and collective human psychology. For instance, being able to identify the key characteristics that differentiate a strong, healthy bull market from a dangerous, wealth-destroying bear market is absolutely fundamental for any trader. Specifically, it is incredibly important for your financial survival and success to learn how to identify and navigate bear markets. You need to understand their typical stages: the initial, often sharp and surprising decline from the peak, the deceptive sucker rallies or bear market rallies that lure unsuspecting investors back in, making them think the worst is over, only for prices to then roll over and make new lows. The long, slow, demoralizing grind downwards as hope fades and despair begins to set in. And eventually, often the capitulation phase, characterized by extreme panic selling and maximum pessimism, which frequently marks the ultimate bottom or a significant tradable low. During each of these distinct stages of a bear market, different trading strategies and approaches might be more appropriate. In the early stages, you might focus heavily on capital preservation, raising cash, or even employing short-selling strategies during the depths of capitulation. If you're a brave contrarian with a long-term view, you might start cautiously looking for deep value opportunities among the wreckage, ignoring these larger cyclical patterns, and just focusing on short-term, micro-level chart setups can easily lead you to be swimming directly against a very powerful market tide, which is a recipe for frustration and losses. And finally, we arrive at rule number 15, and this is a piece of advice that, if taken to heart, can save you from a world of pain, a lot of wasted time, and potentially a significant amount of money lost. Following bad advice, you must cultivate a healthy and profound skepticism towards almost all market forecasts, especially those that come from self-proclaimed gurus, hyped-up analysts on financial television, or sensationalized headlines in the mainstream media. The unvarnished truth, whether people want to admit it or not, is that absolutely nobody on this planet can consistently and accurately predict with any degree of certainty where the stock market or any specific financial instrument is going to go next, not tomorrow, not next week, and certainly not next year. If someone genuinely possessed that ability, that perfect foresight, they wouldn't be selling you a $99 newsletter, appearing on TV, or posting their infallible predictions on social media. They would be quietly and very quickly accumulating one of the world's largest fortunes from a secluded private island. Financial news outlets often thrive on bold predictions, dramatic calls, and sensationalism because it grabs attention and clicks. But these are far more often a form of entertainment or marketing than genuinely actionable, reliable trading advice. Always remember, forecasts are, at best, educated guesses or opinions. They are not immutable facts. There have been countless academic studies and independent analyses conducted over the years that have consistently shown that the accuracy of market gurus, renowned economists, and top-tier analysts' predictions is often no better than a random coin flip, and in some cases, it's demonstrably worse. So, what's the practical implication of this for you, the aspiring or active trader? It means you absolutely learn to do your own thorough analysis. Develop your own well-reasoned market opinions, trust your own diligent research, and above all, stick rigidly to your own well-defined trading plan. Refer back to rule number 1 and rule number 9. You can certainly use information, analysis, and opinions from others as one small piece of the overall puzzle, perhaps to generate ideas or to see what the consensus view is, which can sometimes be useful to fade, per rule number 12. However, should someone else's forecast or hot tip be the sole basis for you risking your hard-earned capital on a trade? The most critical skill here is to develop your critical thinking abilities. If a forecast you encounter happens to align with your own independent, robust analysis, then fine, it might add a tiny bit of confirmation, but if it contradicts your analysis, or if you haven't done your own work, then you should stick to your own plan or stay on the sidelines. Your own well-researched and consistently applied strategy is infinitely more reliable in the long run than any guru's fleeting prediction. Alright guys, so there you have it. A pretty comprehensive rundown of 15 absolutely essential trading rules that, if you genuinely implement them, can truly revolutionize your entire approach to the financial markets. As you've hopefully seen throughout this video, becoming a consistently successful trader isn't about discovering some hidden secret indicator, stumbling upon a holy grail system, or engaging in some kind of get-rich-quick fantasy. It's fundamentally about the consistent and disciplined application of a set of well-understood, proven principles. It's about managing your risk with unwavering diligence, protecting your capital above all else, and maintaining that ironclad discipline to follow your plan, even when it's emotionally challenging. By truly internalizing these rules and making them an integral part of your daily trading routine, you can significantly increase your probability of achieving long-term success. And just as crucially, you'll be far better equipped to avoid the many common, costly pitfalls that unfortunately trip up so many aspiring traders. Now, I completely understand that this is a substantial amount of information to absorb all at once, and it might even feel a bit overwhelming. But please, don't feel like you have to become a master of all these rules overnight. The key to progress is to start implementing them methodically, one by one. And I cannot stress this next point enough, especially if you're relatively new to trading. Please make full use of a demo trading account first. Practice with virtual money, get a feel for the market dynamics, test your understanding of these rules, and strive to achieve consistent profitability in the simulated environment. You even consider risking a single dollar of your real, hard-earned cash. Your trading education is an ongoing journey. Commit to continuous learning, keep refining your approach, because the market is a lifelong and sometimes very expensive teacher. I would genuinely love to hear from you guys now. What are some of the trading rules that you personally live by? Are there any principles that have made a significant difference to your results? Or maybe you have a specific question about one of the 15 rules we discussed today? Please take a moment to drop a comment down below. I make it a point to read every single one. If you found this video valuable and it provided you with some actionable insights, do me a massive favor and absolutely smash that like button. Make sure you subscribe to the channel if you haven't already, and don't forget to hit that notification bell. Thanks so much for watching all the way through, and I'll see you in the next one.